Todd Gleason services are made available to WILL by University of Illinois Extension.
It's time to define a marketing term. Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub joins us. She believes the key to profitable grain trading is building knowledge about the fundamental practices of the industry. Today, she helps us define the word arbitrage. Here's one definition: the simultaneous buying and selling of identical assets in order to take advantage of differing prices for that same asset. That sounds a bit like what a grain elevator does.
Right.
And Elaine, how would you define arbitrage?
Well, I would say it mostly the same way. You're simultaneously buying and selling something, I would say, within the same market space. So they don't have to be identical. For instance, a lot of speculative arbitrages can occur in the grain markets between Kansas City wheat and Chicago wheat. Those are not identical products, but they're within the same market space. And the reason that you do this is because you have a reasonable expectation that the same market space is going to move in the same direction at the same time. So as one of these positions that you take, the sale, for instance, might be making money, and the purchase will simultaneously be losing money. But the idea that you have is that you have an opinion about how the difference between those two assets is going to change, how the spread itself is going to change, and that's where you're making your money on an arbitrage trade, is that you're making relatively more money than you're losing at the exact same time.
And that would be a speculative position.
That would be a speculative position. So the other ones that are very classic in the grain markets are spreading between one crop year and the next, buying old crop corn futures and selling new crop corn futures, or buying soybeans and selling soybeans. But there is a spread trade that's very common within the commercial side of the industry, and that's your crush spreads, your soybeans versus soybean meal and soybean oil. So there are certainly a lot of these arbitrage trades that do occur as part of the cash market, but we just don't necessarily think of them as arbitrage trades or realize that that's what's going on.
And the other possibility for an arbitrage trade is buying one product in one place and selling that same product in a different geographical space.
The geographical arbitrage is very common in the cash grain trading industry. You will notice, that basis gets really hot in one part of the country, but grain is perhaps more available in another part of the country, so you can buy it where it's cheap and sell it where it's high. It's the old adage, buy low, sell high, but you're doing it at the same time and therefore minimizing your risk.
Elaine Kub, commodity broker, analyst, and author of Mastering the Grain Markets. Today, she defined the word arbitrage, the simultaneous buying and selling of identical assets in order to take advantage of differing prices for that same asset.